The Federal Reserve releasing the first part of its annual stress test for big banks moments ago. Wilfred is breaking down the results from the NYSE. Hi, Wilf.
Hi, Melissa. Yes, indeed. So the Fed says that the largest bank holding companies are strongly capitalized and that the 35 largest U.S. banks have enough capital to withstand a severe shock. The Fed Vice Chair for Supervision, Randy Quarles, added that capital levels under the severely adverse scenario are higher than the actual capital levels of large banks in the years leading up to the financial crisis. On average, of the 35 banks tested, the CET1 ratio falls from 12.3% to 7.9% under that severely adverse scenario. And that's despite the test getting harder this year from last year. Under that scenario, it assumes that GDP falls 7.5%, unemployment increases to 10%, equities fall 65%, housing's down 30%, and commercial real estate down 40%. Here are some of the individual results of the big six banks. They all look fairly comfortable. Goldman Sachs is the lowest, which was expected and in part why they suspended their buyback in the last quarter's set of results. The supplementary leverage ratio, which is the ratio of Tier 1 capital to leverage, sees all the banks above their respective minimums. Morgan Stanley and Goldman Sachs fairly low relative to the others, but still above the 3% level needed for next week's CCAR tests. Next week, we will get an outright pass or fail, and we'll learn of the capital return plans for each of the banks. That's pretty much the headlines, Melissa.
All right, Will, thank you. Wilfred Frost from the NYSE. I turn to Karen because this is sort of perfunctory in some ways. Next week is the big show.
Next week is the big show.
What are you looking for here?
I'm looking for, well, the big three that Citibank, I think, is the most upside. I think, that's the most leverage to having a balance sheet that can do something with. So that's my biggest position. But I think all of them would be in good shape. I know that everyone knows that already and that people are expecting, we'll see buybacks, maybe some dividend increases. However, the stocks have not run up into this at all. So I like them all right here. I got to say, kudos to Guy, Deutsche Bank. They're not one of the 35. They're not U.S., but Guy has been so on it for at least a year.
Well, that's the blind squirrel thing. You just pick a bank out of the hat and hope it works.
But Deutsche Bank's your nut.
That acorn.
Listen, I think maybe one of the reasons the U.S. banks are trading as poorly as they are, maybe there is some systemic risk with Deutsche Bank. Maybe there's more to this than we want to talk about. And the fact that it's a European domiciled bank and we don't talk about it every night here, maybe that's the only reason. Maybe if it was a U.S. bank, we would talk about it every night. There's something very wrong there. And I got to believe at a certain point it affects other banks. And maybe that's why U.S. banks haven't rallied.
I believe Fitch just put it on negative outlook for Deutsche Bank this afternoon. But in terms of CCAR next week and learning, I mean, Karen made the point that the banks are not running up into this.
The fact that they act horrible into it doesn't make me feel any better either.
Oh, you don't think it's going to be a catalyst either?
No. I actually think you could get a sell the news when it finally happens.
Oh, so the sell-off would be even weaker,
and I'll tell you, so if you're waiting for companies like Goldman Sachs that are down almost 20% from their all-time highs that they made earlier this year to reinstate their buyback, and you think the stock's going to go back to the highs on that, you got another thing coming. And then, the thought that the repeal of some of the Volcker stuff, that's going to be great. These guys are going to start, taking risk on their own balance sheets again. Do you think that they have really the risk reward there to start doing that? The upside downside is so asymmetric. If they get that wrong, they will be in the penalty box for years to come from here on out. So to me, I just think it's a relatively benign group right here. Have a ball. Buy Citigroup down 9% on the year, or Goldman Sachs down 10% of the year. Maybe they go back to their prior highs. I don't know. But to me, it seems like a kind of one up, maybe 1.5 down risk reward right here.
So where do you think they should be trading then?
Well, listen, you guys keep talking about, price to book. It should get back to, some of the levels. It should never get back to those levels. So they're probably all fairly priced right here. When you consider what the positive catalysts that are very well known out there are, especially after this announcement that we have next week, you say to yourself, why the heck would anybody rally these stocks afterwards if it's not meaningfully above expectations?
Well, if you want to buy them, they're actually pretty good risk reward on a trading level here, right? So take a look at something like Citibank, again, $65. You know where your stop out is. You know that you have, you can say, hey, listen, I want to risk $1 or $2 and get that upside. If they break below that, and you look at XLF, I think it's about 26 or 28, I forget the number right now, that the major support has been there. If it breaks that, you've got a problem, but at least you can use that as your stop, and you got a great risk reward.
You know how you could kind of set stops and do that?
Risk reversal.
Well, with the options.
Oh, is that so?
I mean, if Pete was sitting right here, he'd be like, listen, and I don't disagree with you. If you look at JP Morgan, the stock's at 107.5, 105 is that breakdown level. If you think it's a great play into their Q2 earnings in next month and you think CCAR is a thing, then buy the near the money calls, risk 2% and have that potential upside, but you define your risk to that breakdown level.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.